What's going on, investors? It's AK from Fallible here, and today we are going to talk about another psychological defect that we all seem to have. One of many. So dysfunctional. But this has to do with how we size our positions when we're winning in the market versus when we're losing. And we're going to go over a great article that discusses it from Michael Batnick, the irrelevant investor. Oh man, come on, Michael, don't say that. You're not irrelevant. You're important to me. You are so relevant to me. Michael, can't you see? Look out for my mixtape. So the article is titled, What Happens After You Win? And I'll put a link to this article in the description. Go check it out. So Mike says when he's in a casino, he tends to do two things. He bets conservatively when he's winning and aggressively when he's losing. That is not rational behavior, but he's not alone. This affliction runs rampant in our species. Like I was saying, we got so many problems up here. So economists reviewed more than 500,000 online poker hands and looked at how big gains or losses influences short-term behavior. They concluded that after a loss, about 2/3 of players are looser and more likely to bet to stay in a game than after a win. And that rationally doesn't make sense, does it? So what happens is that losing players tend to count their chips after a winning streak. They start getting paranoid after they win, and they become paralyzed by the fear of giving back the winnings that they just got. And that's what you see in markets, right? As soon as you get a few gains, you're thinking about taking it off the table, just completely cutting the position. Which, yeah, if you have a strategy where you take some chips off the table at certain targets, that makes sense. But I'm talking about the urge we get to just pull our position out completely when we just made a few bucks. You get a little bit and you become real protective over that little bit. Losing money has the opposite effect though. When we lose money and have a chance to win it back right away or even come out ahead, not only do we take more risk, but we take even bigger risks and thereby subject ourselves to even bigger losses. Honestly, if we wanted to avoid loss, it'd be better just to walk away. But the break-even effect, the mentality of us trying to get back to even, never taking the loss home with us, that explains the conviction that the next hand of blackjack or the next coin in the slot machine will make you whole or win back your money and then some. Again, in the markets, you see people who don't want to cut their losses because if they cut their loss and actually sell their position, that paper profit, or paper loss actually, that will turn into a real loss. So like if you're losing at the casino and you actually cash out your chips, that means you got to take that loss home. No one wants one of those half-naked casino waitresses looking at you like you're a loser. They only like you when you tip them, so you want to make sure you got all the tips they need. So there was a new paper that came out by Essentia Analytics called Holding the Line, where they revealed the results of a new study that tracked investors over a period spanning 10 years to find out how winning and losing affected their short-term performance. So here's what they found out. Over half of portfolio managers changed their behavior in one way or another when on a streak. Nearly 1 in 4 changed it when they were winning, and 41% changed it when they were losing. So losing affects your mindset a lot more than winning does. 41% versus 25% were more likely to change when losing. And when managers were on a winning streak, the majority of them traded less often and made fewer decisions. And that's actually good, as I figured, because the decisions they make when on a winning streak tend to destroy value. If something's working, like if a position is working for you, just walk away. Like, don't touch it, because anything you do is likely going to screw it up. And this is a problem when investors, or traders, we get antsy just sitting in our seats not doing anything. Like, even if something is winning, it's not as fun because we want to get in there and click, right? We want to trade around the position, which, yes, if you're a very good trader, you could do, but most of the time it's just an excuse for screwing around. When they were on a losing streak, managers typically traded more often and in larger size, increasing portfolio turnover. Oh geez. Those decisions tended to destroy even more value. Sometimes it sucks to be a portfolio manager too, because you got to perform to a benchmark. You've got that career risk of your job on the line if you're not performing. So I can see a portfolio manager who's losing trading more, trying to make that benchmark, hit that target that he needs to hit so he doesn't get fired. It just fuels that bad mentality. So feel lucky if you're not managing anyone's money but your own. There are a lot of benefits to that. So Mike explains here, in the casino, a lot of people become overprotective of their winnings when they win, and others become more emboldened after a winning streak, meaning they start betting more. And in a game of chance, that doesn't always make sense, because if it is completely random, you're going to get that reversion to the mean. You're going to win some, you're going to lose some. A streak doesn't matter as much. So pressing your winners when you're on a winning streak is a good way to give it all back and then some. But in the stock market, it's different, because the stock market has momentum. So an emboldened investor can turn his bravado into his or her advantage. And you guys know how I feel about momentum in the stock market. That's what my entire strategy is based off of. That NASDAQ All-Star systematic strategy, all it does is measure momentum and trade based off that. Which, if you don't know what I'm talking about, I explain the system here in this video. You can click that and you'll go to it. But I will say, in our system, we don't increase position sizes as the thing goes our way. I used to do that when I was discretionary, where I would wait for another pattern to form, and then once that pattern broke up to the right side, I would add more to my position. It was pyramid. pyramiding, right? And both ways work. I mean, for me, when I was trying to pyramid, I didn't do it that well. So I would screw it up, which is why this system was a little easier for me, because you don't pyramid. You're actually taking some chips off the table as you move higher. You're not taking all of them off because of that psychological bias we've been talking about to hoard your winnings. It's more about risk management, taking 25% off at the first target and then so on and so forth at each target. It reduces your volatility, lets you lock in some profits, and it makes sure that you don't have that round tripper where you had all these profits and they're all gone. Because guess what? Just like with losses, with profits, you actually got to sell the damn thing before you can lock in that profit. Otherwise, it's all paper. But I mean, even when you sell it, it turns into paper too, and it's all fiat currency anyway. So what's the point of money, really? Do you have Bitcoin? I love Bitcoin. Michael says it's hard to bet big when you're winning, and it's really hard to buy a stock that gaps up 15%. But this is what winners do. Hell yeah, it's hard to buy stocks that gap up. Like, look at Mercado Libre. My system told me to get in after its latest earnings report where it jumped 20%. So I was getting in here after it already jumped, and I was like, oh no, this is gonna work out. Because what I see a lot after a big jump like this, a stock can just go sideways and kind of consolidate, or it can go back down and kind of fill that gap. But when you're dealing with high momentum, like I'm dealing with in this system that I'm using, the NASDAQ All-Stars, when something pops like this, it's a good signal. It's high momentum, you jump in. So from there, so far where I got in after that 20% jump, it shot up another 11%. So it's working out. But yeah, it is not easy to do that. But I mean, that's why I don't discretionary trade anymore, because before, in my previous strategy, I would have never jumped in there. Did I really have a reason? I don't know. If you don't got a plan, then I don't really trust your reasoning in the heat of the moment, because it's just going to be influenced by one thing or another, where you really just want to be sticking to the data, which is why I like the back-tested system, because then I just turn my brain off and just do what I already planned to do beforehand that I know is statistically probable to work. In the words of George Soros, it takes courage to be a pig. And Druckenmiller was one of those rare people who possessed the ability to walk away after a small loss and the courage to bet huge when the market went his way. It's tortoise portus, right? Or tortoise porces. I don't speak Latin, but it's the whole hog, the entire ham. That's what it means to bet big. I don't know if you guys know what I'm talking about, but we'll do another Druck video soon. In his interview with Real Vision, oh hey, I have a show with Real Vision, so I guess me and Druck are esteemed colleagues, huh? Just a couple of esteemed collard greens. Me and Druck. But he said the most important job for a money manager is to understand when they're cold and hot. Druck is all about the streaks, and he has that discretion and that deep market knowledge and experience, and that natural God-given talent, really, where he's able to do what Mike Batnick was just saying, right? Lever up to really go for the jugular and make all his money, and then also feel when he's off a little bit and just to walk away. Your brain works against you when you're cold and when you're hot. Everyone knows this. But the difference between knowing and executing is why the market wizard books sit on millions of bookshelves and why there are so few market wizards. Ouch. What a line to end it. I can't do better than that. If only there was a Hogwarts for market wizards, huh? Well, there's not, and this is nothing close to it, but download my FOMO trading guide. It's a great guide. It'll teach you some tips and tricks to control your emotions and your cognitive biases, just like the ones we talked about in this video. And all you gotta do is go here and enter your email. Hit that button. Put your name in too if you want me to talk to you and know your name. And I will send it to you for free. And the link to this page is up above in the video right here or down below in description, comments, you know, it's everywhere. Go do that. And if you haven't already, make sure you subscribe to this channel too. Hit that notification bell so you get a notification when our next video comes out. Thank you, Michael, the relevant investor, to me anyway. But him and his team are super smart. We'll share more of their stuff. Come back for it. Subscribe, and I will see you in the next video. Stay fallible out there. Bye.